Good evening, ladies and gentlemen. There's way too much going on here, and I still need a damn haircut, but we're going to try our best here on a long weekend for those of you that are in Canada. We're going to break down robots. We got to talk about more robots. I got some cool videos I want to share with you guys. We're going to talk about the value of the S&P 500 based on the total earnings that we've kind of accumulated so far in the second half of the year, what might potentially happen into the future. We got to talk about chips, of course, NVIDIA, what the future looks like for NVIDIA, because now we have guidance expectations as well. Some of you were asking me about expense ratios and how much it truly costs you and why I have limitations on how much expense I'm willing to pay. We'll talk about Canadian banks, damn it, meet Kevin, the bearish sentiment just going on in the markets, and so much more in between as we do here. I missed last week's live stream, but I'm showing up this week. I'm kind of getting burnt out. I'm working way too much these days, but damn it, we're here to have a good time. We're here to talk about money, value, baby, and bring it into the future. So let's get right into it. First and foremost, just something cool because I like talking about robots. I'm still very bullish on this sector. And if I wasn't so hesitant around Tesla stock, I'd probably still own it. But I'm going to wait and see how this kind of pans out here a little bit, folks. But I was watching this 1X basically builds humanoids for the home. And I feel like they're probably, I don't want to say they're most on the forefront because honestly, all the videos I've seen so far, you know, they're variant because they're still like training the models for these things. But what I found most interesting about this company is the guidance. I mean, you can go check out their videos on their YouTube channel if you want, but I really just want you to listen to one aspect of a video that I was watching that I just find really interesting because, you know, we always hear like Elon Musk timelines. Oh, it's going to be ready for production next year. It's like, I think these guys, you know, really kind of brought this down to earth in an interesting way. And I just wanted to take a quick listen to this. Let me just turn it up here, make sure you guys can hear this. All right.
Just have to work on day one. So as a technologist, I'm super excited about the possibility that the physical world becomes a computer. This would basically be a huge economic unlock in the amount of productivity we can do. Of course, there's also the benefits to the aging demographics. And I think this kind of technology is really essential for the survival of the species if we're going to keep growing the size of the population and keep a high standard of living for everyone on the planet. And then also it's just extremely amusing to see robots struggling and also succeeding. I think that really inspires me when the robots actually can do something.
I love this
smart.
So 2025 will be the year of scaling this. 2026 is kind of like still early adopter, scaling manufacturing, gathering all the data to make the systems intelligent enough to be really, really genuinely useful. 2027 is probably where we start to see that the systems are intelligent enough that we can apply them to other domains. So going into everything from like manufacturing to service industry, warehouses. I think at that point you've hit kind of the sweet spot where these affordable systems are useful enough that the unit economics are just crazy. And you're going to be severely bottlenecked by how quickly can you manufacture this. 2027, 2028, 2029, 2030, it's going to be all about manufacturing at scale. And how do we get to billions of droids? We're figuring out how to process right now. But what I can say is that we can manufacture this at a cost of a relatively affordable car. And then I'm not talking about a car that someone in Silicon Valley would buy.
Yeah, so it's super interesting company here. And I like the timeline perspective. And there's always kind of like that inflection point. Same thing like with NVIDIA, right? Where all the demand for the chips started to pull forward so dramatically that like, you know, the scale just took off. And I feel like this is every nuanced industry. This is like, you know, Tesla self-driving. This is everything. It's like, when do we get to the point where you reach that critical, you know, faculty where things just finally explode and the demand for value you know, actualizes? It's a super interesting thing. And, you know, the Tesla debate goes on, obviously, like I was super critical in my recent video, you know, so I want to own Tesla. I'm also hoping they start meeting targets. Yeah, I have a love-hate relationship with Tesla. I don't like the political stuff anymore either. I hate how Elon is so like politically driven on, you know, X these days. I feel like if he could have just stayed out of it, it'd have been better, considering like the Democrats are a lot more EV centric than the Republicans are. It's an interesting stock to own right now. Like I said, I have such a hard stomaching. If it goes back to the right value, I'd potentially buy it again. What's Tesla trading at today anyways? You know, like I said, I have a hard time owning things long term because I become such a value, you know, I don't know what the term, like a value junkie. It's just like I can see where there is value in the market with stocks that nobody wants to talk about or own, but then all the stocks everyone wants to talk about is what's driving the views and the attention and the overvaluations. And I'm waiting for the day that Tesla comes back down to reality for a little bit. And reality, I still think is extended because you're always going to put a future valuation on this. But again, it's that debate on why is it trading at a multiple that's higher than Nvidia's right now, yet they have absolutely no growth behind them for the time being. So, there's a lot of hype and hope built into it. So if the stock could ever just cut in half, I'd be on this like you wouldn't believe. But, you just kind of got to wait. And I'd rather wait for that initial value to start pulling forward and get to that inflection point where we start seeing growth come back. And then I can buy the rally, in my opinion. But you never know. You never know. If you want to own it long-term, no problem buying it up here. Just you have to be able to stomach the extreme volatility and know you might not see returns for another, good few years, let alone followed by a drop. It's still really likely. Seems like Elon talks more than the Kathy or Carrie would these days. I'm a realist, in my opinion. First robots people will pay for with, it's the same thing I'm saying about AI. I keep arguing the AI story is going to be largely related to more than likely self-driving in the porn industry. That's where it's going to really wreak havoc first and foremost. But let's talk about the S&P value, because at the end of the day, this is my solace. This is my place where I if that's the right word, I come to for just solitude, relaxation, guaranteed almost returns. I don't have to worry when I'm buying this. If Tesla takes off, I still own it. It'll work its way to the top of the list passively with nobody's opinions coming into play. That's why I love my S&P so much. But realistically, it's fun talking about the valuations around this and speculating on the future, even though nobody really knows anyways, because we're always kind of sitting here trying to debate on, are we in a bubble? Are we not in a bubble? Is this thing going to burst? I know we're trading at relatively high multiples, but based on forward growth, this is really interesting because I was reading a report that comes out, and it's always fun because I don't think everyone ever takes into perspective a lot of the broader circumstance of the companies, the 500 companies that sit in the S&P. But earnings scorecard for Q2 of 2024 with 93%. Am I sharing this? Let me make sure you guys can see this here. Let me zoom in a little bit more as well. With 93% of the S&P 500 companies reporting actual results, 79% of the S&P 500 companies have reported a positive EPS surprise, and 60% of the S&P 500 companies have reported a positive revenue surprise. Earnings growth for Q2 2024, the blended year-over-year earnings growth rate for the S&P 500 is 10.9%. If 10.9% is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth rate reported by the index since Q4 of 2021. Earnings guidance for Q3 2024, 48 of the S&P 500 companies have issued negative EPS guidance, which is hilarious because it's only 48. So it barely represents, what is that, like not even 10%. And 41 of the S&P 500 companies have issued positive EPS guidance. So that's for what we get for positive looking forward. There's probably not all the companies are, I don't think this takes into consideration everything probably. But valuations for the 12-month PE ratio for the S&P 500 is 21. So again, this is the forward 12-month PE. This PE ratio is above the 5-year average of 19.4 and above the 10-year average of 17.9. But we can see as time's gone on, it's been pulling the averages up because lately we've been trading in much higher multiples. I don't think 21's that bad of a forward multiple. If we continue to see growth rates above 10%, like I said, it's hard to tell because we don't know where the future is going, but presuming the US continues to be a juggernaut of companies like Nvidia and, Tesla maybe pulls a rabbit out of its hat and robotics really takes off and self-driving works, or the economy continues to evolve at an exponential rate. This is going to be really interesting. But yeah, this is my place of sell. I'm still coming here, baby. If we take a look at the week, however, obviously it's a mixed bag for tech earnings because I still think tech, even though it's going to pull forward a lot of this value, still needs to start pulling a magic rabbit out of a hat because nobody still wants to believe that AI is a bubble. But I think the bubble is slowly starting to show signs. I think we're kind of starting to see the petering end of the wicked rallies that AI was able to pull, like it has, because there's no companies, even Microsoft. I get that there's like capital gain valuations, like ChatGPT's value is absolutely absurd today, but there's no way to like recognize what the value of that is within Microsoft's balance sheet at the moment. They have no, there's no reflection of revenue or earnings growth. Microsoft is sitting in the same bag that it was 3 years ago or whatever, and it's still not like worth, I think, the absurd value that it's kind of providing. I mean, Apple's similar boat. Nvidia is probably the only one that was trying to justify an absurd value. And some of you are asking me about the chip sector, right? Like, is it worth getting in chips right now? I have such a love-hate relationship toward chips because like I recognize the value of them so much earlier on, and I sold TSM and I never got back into any of it, even though like oil is like the new oil is chips, right? So when you guys are asking me about these kind of ETFs, these sector focused ETFs, I think they're interesting, but I still can't bring myself to want to buy them because again, like it depends on what you're trying to do here. Like I can't see myself getting involved with the trade with like, you know, the chip ETF. I could see myself trading Nvidia a little bit here and there, maybe. I haven't done it, obviously, but I recognize the value when it drops enough or whatever, and I didn't play it. But even now, I mean, the valuation is starting to make a little bit more, historical sense for Nvidia. But when it comes to the chip sector as a whole, I just have a hard time trying to understand where it is 5-10 years from now, because you go back, 10-15 years ago, and the chip sector just didn't look like it does today, and it's just so hard understanding, like, do fundamental silicon chips change over time? Do we start seeing like quantum computing take over? What does 20 years look like in this sector? And I don't think anybody can put their finger on it, because I mean, we couldn't really project out what the last 2 years have looked like. It kind of just came out of the side blinders here. And now the hard thing to stomach is that Nvidia is going to start to slow down, right? Like they're reaching scale, and at scale, like the easy money's been made. I think this is half the reason that Nvidia's stock tanked so bad on earnings, right? Like people are like, okay, the fun is behind us. We've got year over year 122% growth. I think we're going to start saying bye to that very soon. Because I guess for the next quarter, you're going to be looking back a little bit. But I mean, the fact is quarter over quarter now, this growth rate is slowing down. The margins have reached their peak by the looks of it. 78% margins were disgusting. We're not getting those really quoted in future guidance. But you take a look at expected revenue for the next quarter is going to be about 32.5 billion, which is a hell of a lot lower than, the growth rates we saw from Q2, of last year to this quarter. So, I mean, we're kind of getting to this slowing pace of scale of economics when it comes to how much, demand they can keep up with. Unless, who knows, maybe they're building some more facilities. I don't know what they're doing to meet the demand. I don't live in the Nvidia factories, but God knows when you get into generating $30 billion, I'd love to see them get to Apple's income. I mean, we're nowhere near there yet either, right? So that's why Nvidia is so extremely expensive. You got a $16-17 billion of net income. I think Apple's pulling in like 21, something like that, somewhere in the low 20 billion, net income range. So it'll be neat to see what happens. They're not, the margins they're guiding still a bit lower here, nothing crazy. GAAP operating expenses, nothing crazy here. Do we have GAAP net income? I don't have to read too deep into this. Data centers are very interesting here. Second quarter revenue was, data centers are driving so much here growth for these guys too. Yeah, it's fascinating, man. The chip sector as a whole is super, super fascinating. I'm just going to keep playing it through the S&P 500. We can, talk more about it in the future. What are you guys saying here? I personally invest into HXS, which is in the total return beats VO and dividends reinvested. Buy the fund so I don't pay the 15% withholding. Check it out. HXQ. Okay, I'll keep this on my mind and we'll pull it up in a quick bit here. A recession is around the corner. I've been hearing that for a very long time. I think we hit a technical recession during the pandemic because we had 2 straight quarters of negative GDP. But does it really affect the market? I don't think so. Not as much as it did, unless we see some it's just earnings right now are just still shocking, right? I don't know. I feel like we're going to see a soft landing. At least I hope we do, because it's going to slap everyone upside the head to remind them that nobody really knows what the hell is going on. And some of you, I'll read another comment here. It's kind of interesting. One of you were pointing out, great info. I was hoping for a bit more insight. This is like one of the most fascinating things with all these ETFs, as well as the expense ratio, right? He says he's, on the effect of expense ratios decades into the future, 23 years old, long-term investor. Where does, long-term investor where one of my ETFs has a 0.78% MER. So if you're super young, I hate these MER fees that are this high. I think Dave Ramsey doesn't care. He's like, oh, well, if you're not managing and screwing up your portfolio, it's worth paying this. But if you're only in your 20s, I can really show you how much a 0.78% management fee is costing you and why my brinking limit is usually 0.2, 0.3. If you take 0.78% of $100,000, let's say you get to that level, and I'm sure you will if you're already figuring this stuff out and you're that early in your 20s. 100K and $1 million is an inevitability if you keep this going. So if you're going to kind of stick with those kind of ETFs, 100K at point, is $780 at 0.78% expense. If you take that $780 and that's all you were investing annually over a 25-year period, if I have this made out correctly, at a 10% return is something like $84,000, if I'm calculating that correctly. $780 doesn't sound like a lot, but over 25, even over 40 years, like let's say you get to your 60s, right? I mean, that could be a few $100,000. It's kind of crazy to see what $780 can do. Like even $500, right? Like, I mean, $500 over 40 years at 10% is $250,000. It's like, long scale period. It's kind of hard to believe this, even when I'm looking at it. You're looking at this, it's just like $500. Really? That's how much $500 can become in 40 years. It's kind of like insane, right? So you got to be a little careful because am I even sharing this? Let me pull this up. I'm not even sharing this to you guys. It's such a shame. So you got $780. I'm running it through this expense calculator. You take a look at this, right? A compound calculating. If you keep getting 10% off the S&P 500 over 40 years to grow it, $500 annually turns into about $250,000. That's how much money you'd be giving up in an expense ratio. It's kind of mind-boggling, isn't it? Now you know why like people get greedy and they're like, there's not that much money, guys. A percent expense ratio is not that much money. When you start talking about long periods of time and big numbers, it starts getting kind of disgusting. This is why it's great to be a money manager who thinks long term. You become like Kathy Wood and you're getting like billions of dollars at like 0.5% expense ratios and stuff like that. It's kind of wild. But taking a look here at my portfolio first and foremost, and the reason that I don't see a point, like this is another hard reason that I have to invest in things on an individual basis outside of what we already hold. It's just you look at what you get in the S&P, and like even with 53% exposure to the S&P that I have, Microsoft, Apple, and Nvidia are the three largest positions. And I still argue with people to this day. They're like, oh, you buy an index fund isn't buying an individual stock. It's not the same thing. It's like, it's literally the exact same thing. I am just using a basket that has a mechanism behind it that is like more passive than anything you're going to do. And it's a mechanism that has been like, outperformed 95% of fund managers. So it's like, when I look at this, it's like you own these stocks, 10% of my portfolio is largely dictated behind 3 companies, or almost 11%. So it's like, I got to be careful what I'm doing. And I think people get carried away with index funds as well, because I still feel like the S&P is maybe for most people a little bit overexposed to technology to some extent, especially at, some of these higher values. But if you're in your 20s, who gives a shit, right? Like if you're 20 years old, I just always think about like, I'm always kind of stuck between this like, bipolar-ish, my parents that are in retirement and me in my mid-30s or getting into my 30s here. And then my mind of where I was at when I was 20. And it's like, it's so hard to talk about things. The more I do investing, the harder and harder it is to be like, this is the way it works, folks, because you could just be a strongman personal finance guy and you just buy your VTI or whatever. But I don't think that's also appropriate, right? Like for my parents that are in retirement, I don't like VTI. I think it's a garbage investment for my parents that are in the retirement. Because you're kind of looking for, you don't want to manage it a lot, but you want to be able to, still get growth, but you still want to have the vast majority income. So what's the perfect combination of that for someone in retirement where you mostly don't have to touch your investments? It's tricky business. But yeah, I'm fairly happy, right? Like, I feel like I'm kind of getting to the point of pure boredom when it comes to my portfolio. And I'm trying to figure out, is degeneracy the best thing to possibly do for my YouTube channel? It's like, just purely individual stocks. I feel like as much as I've watched YouTube in the history of my career in the finance space, most people have gotten bored and moved on. Graham Stephan is basically quitted YouTube. I mean, you either have to go down the dangerous path of, okay, I know what works for most people, but I'm not going to do it. You kind of get the rogue guys out there, your echoes from above, your strongman personal finance, these guys that are like, this is the real way of doing it, but you're all doing it wrong because you're a bunch of degenerate clowns that are just, GME YOLOing life. And I don't know, I find it so interesting how much the finance landscape has changed on YouTube. It's become just such a, like here's a good example, right? Like I always feel like the Meet Kevin is a barometer for money, and Meet Kevin doesn't care about making you money as much as he cares about making himself money. And when you look at the state of YouTube, he knows what works, and that's, talk about clicks. You want clicks. So negativity drives clicks. When you look at all his videos, They are the utmost negative clickbait things you can get into. And I mean, the guy was basically full blown recession fear, like on the mild 8% dip that we had that has already been gobbled up, So it's like, this is what the state of YouTube looks like for finance. I feel like it was a lot more innocent back in the day. I mean, go back and watch finance YouTube videos from even I don't know, you go back to 2018, 2019 time period, and it was so interesting. People with whiteboards, people really just talking about slow valuation builds up and working hard and doing all this shit. That's kind of drawn out at this point, right? Now it's all about selling. What are we going to sell? What's going to get clicks? What's going to drive views? And if you can't kind of degeneratize yourself down to that level, which a lot of people do, you'll see it. Most people won't even show you their own portfolios anymore. And they'll just go show you their clickbait portfolio where they just want to show you the degeneracy of I can outperform the market by picking individual stocks. Even though in the back of their mind and in their own fucking wallet, it's purely S&P 500 Qs, shit they know they should be doing, but they can't get clicks to do. So they're going to try and draw you down the path of degeneracy. It's a beautiful thing, the finance space on YouTube. And this is just me kind of rambling for no apparent reason. Some of you point out too that my own, they point out how crazy how you flip-flop on your stances while talking so arrogantly like you're correct every time. I am so again, this is my own degeneracy in the stock market. Right? When I'm talking about stocks, I can talk about them like a salesperson. I can sell them to anybody. I'm a salesperson. It's this is my job. Everyone, and whether you're selling yourself to a girl, you're selling your car at your job, and you're a sales dude just flipping cars out of the dealership or at McDonald's, you're selling something always. So you kind of get behind it, right? And then all of a sudden, I watch some stuff and I change my mind, and all those hardcore sales pitches go out the door, and now I'm flip-flopping like Meet Kevin does, and I'm selling out of Tesla stock, and I'm I'm just hoping you recognize the reality of I over-exaggerate a lot of what I talk about on here, and I do my best because I enjoy the data and I enjoy balance sheets and I enjoy learning this stuff, and I could be horrifically wrong, which is why it's not financial advice. But I like to think that, I'm right for the most part. I make decisions that have worked out for me greatly over the long run. And I try and do it very steadily. If I was more degenerate, I'd have made a lot more money. And that's what I kind of regret. And I'm having that immoral debate in my head of I could have had so much more if I just leverage. But that is the salt that will infinitely burn wounds in the future. It's you're just starting to stir a stake in your mind where you're I can do this again. And then you make one bad error and you wipe out half your portfolio overnight. So, I mean, you got to be a little careful. It's this mental mind game of it worked in the past. It doesn't mean it's always going to work in the future. But I wish, again, the degeneracy in me was a bit stronger back in the day. The force was not strong with this one. I made good decisions and I had good stocks, but the force wasn't strong enough to make me 3x leverage those stocks. Some of you have been pointing out too, which I always find having these fun debates on Canadian companies. And if you're not Canadian watching this, I still think it's an interesting debate because the Canadian banking sector globally has been it has been the most world-renowned financial sector globally. The Canadian banks are so utterly fascinating because they have ridden through over 100 years of just horrendous crashes and economic wars and downfalls. And unlike the US and Greece and all these other countries you can go to, our banks have just rode through it like it's nothing, absolutely nothing. So the S&P 500, anything in Canada, Canadian banks have significantly underperformed the S&P 500 over 5 years, 10 years, 20 years. It's not even close. Total returns is all that matters. Dividends are a joke. Canadian banks are reported to bail in legislation, moral hazard, of course, but isn't worry-free investing, at least in my mind. Set and forget the S&P 500 is a winning strategy, no doubt. Dividends do matter, especially if you have a drip set up in their own way. So here's the interesting thing, too, that I love promoting the S&P 500, but I recognize that you could end up in a lull period. And I'll bring this back around to the banks. Because, I mean, from 2001 to 2013, you basically didn't make a return in the S&P 500. I think we've kind of got a recency bias where it's in perpetual gains, which is a beautiful thing. But it's another reason that stops me from throwing all my money in the S&P, because I recognize over long periods of time, you can get into very dull periods of the market where dividends have significantly outperformed. But I think this guy hasn't zoomed out enough on the Canadian banks, because statistically or historically, the Canadian banks have outperformed the S&P 500, at least for as long as the S&P has been public here. If you go back to like 1995 on SPY, pretty much all the Canadian banks, with a few exceptions, if you include dividends reinvested, they have dramatically outperformed the S&P 500. Yeah, I mean, if you look at a 5-year chart, it's not nearly as entertaining, because for the last 15 years, tech has done nothing but run up dramatically. But if you go back far enough, the Canadian banks have been so damn resilient. They outpaced the market during the 2008, like that 2021 period to like 2010. The banks just absolutely slaughtered the S&P 500. And because of that period, that's where tech really started to become resilient, was from like 2010 onward. And then the S&P really started to catch back up to the lack of performance that it had during the 2000s, right? So I don't think it's fair to criticize the banks and say, oh, they underperform. It's like, well, if the S&P ever, like, if a tactical nuke gets dropped and the US goes into a full-blown war, whoever the hell knows what happens tomorrow and a black swan event hits, all these companies are going to get absolutely cratered, but, they're going to try and maintain. And the ones that are paying yields, are going to look a lot more attractive, than the S&P might look with tech. I don't know. Who the hell knows, right? I'm just saying, like, you shouldn't, even a 10 and 20, like a 10, 15-year chart's not great, but you start looking at a 20-year chart, and the Canadian banks all of a sudden look pretty great, especially with dividends reinvested. These are just capital gain charts, by the way, so do keep that in mind. RioCan, we're going to talk about the RioCan. I got to do a video on Rio, if that's what you're talking about. Banks equal Buffett. I mean, yeah, Buffett's got Bank of America, right? I mean, they're just highly stable investments that over very, very, very long periods of time tend to outperform and do exceptionally well, because they're grandpa stocks, and nobody likes to buy grandpa stocks. Let's be real. But again, if you bought the dips on the banks, I think you would be outperforming the S&P 500 as of late, right? I mean, some of these dips that you could have picked up on these banks, like Royal Bank, if you bought the dips here, I mean, you're outpacing the S&P 500 in returns this year for sure. It does come down to when you bought them. Like even on the 1-year basis, I mean, Royal Bank's outperforming the S&P 500. Yeah, the other banks aren't right now, and there's the ebb and flow for sure, but I don't think it's fair to shit on the Canadian banks. I love them greatly, and they are definitely, a staple to my portfolio. I think right now, even with my exposure to VDY, as limited as it is, I think Royal Bank is what? I mean, it's like the 5th largest position in my portfolio right now, just because of, index weightings, which is beautiful. And I love that too. If I look for the best ETFs in the economies and stuff, and you just average them out, it's nice to see all the best companies that, on a passively weighted system that is, the S&P's VOO or, VDY, and these ETFs, like they just give you the best stocks. So if you just cost average into these things, you end up getting, the best companies weighted to the top. So you still get like decent performance. Does not Buffett own BlackRock when you trace it down? Let's take a quick look. Does Buffett own BlackRock? Here, let me just pull it up real quick, and we'll take let's take a look at Buffett's Berkshire portfolio tracker. Yeah, I'm surprised too at how much Buffett's become. The Berkshire portfolio has become so traded over the years. It's very interesting to me, especially with the clash between Ray Dalio and Warren Buffett. I'll show you Ray Dalio's portfolio too, if you haven't seen it recently. But if we take a look, I don't know if BlackRock's in here. I know the top holdings, we've got Apple, Bank of America, American Express, you've got Coca-Cola, Chevron, all that stuff. Let's just take a look and see if we can find it here. MasterCard's in here, which is awesome. These really grandpa-oriented stocks. We've got Liberty Medical Corp, Sirius. Oh my God, there's so many companies in here still. He even owns the S&P 500. Look at that. There's VOO and SPY. I don't see BlackRock in here, though. I could be wrong. Maybe I'm wrong. Does he own BlackRock? I thought you were right, too. Either way, it's really interesting that he scaled down. Look at Bank of America right now. Bank of America is his 2nd largest position next to Apple. Apple's no longer this juggernaut position. I mean, it's still a juggernaut position for him, but it's kind of crazy to think that, he's betting on Apple just as much as he's betting on Bank of America right now. But I want to show you the difference, too, because I love Ray Dalio, and I think he's like one of the smartest people. What's his portfolio? Bridgewater. Let me pull it up here. Yeah, you take a look at Bridgewater and Associates, and just to see the absolutely epic divergence between billionaire investors. Now, keep in mind, Ray Dalio is not a top 10 company like Berkshire Hathaway is, but still, nonetheless, world-renowned investor, right? And I just find it wildly interesting that, he's got his broad market ETFs like IVV and IEMG, like these emerging market things. But then he's got Google and Nvidia are like the two largest companies here, right? And he's been lowering the positions in them too, right? Like he's been scaling them down a little bit. And then you got like Procter & Gamble, Amazon, Microsoft. It's just such an interesting mix of stocks. And I love Ray Dalio's portfolio. I think this portfolio more aligns with like the way I think about the market. But then again, I can own most of these stocks just by buying the S&P 500. That's the other thing that I always find interesting too. It's like, why would you invest with Ray Dalio when he's basically just a broad index investor at this point? This is like the clash. And I think this is why Buffett has become like a top 10 company, is because Buffett has been incredibly good at concentrating stocks, and you'll never get outsized performance without concentration. So I think that's why Buffett's done so well, whereas Ray Dalio is so broad-based in his investment strategy that you might as well just buy the S&P or something. And if you love Canada, just buy like VCE or the broad Canadian index, because it's so diversified, right? Again, you might not think it's diversified, but to me, like, I don't know why you'd upperweight these so heavily at, look at it. It's so, like, to put it in perspective, Google is what? It's a little more upperweighted than Apple would be or Microsoft would be in the S&P 500, but NVIDIA is only like 4.2%. Like in my portfolio, even though the S&P is only 53% of my entire portfolio, mixed with SCHD and all these other stocks, like I still have like over 3% exposure to NVIDIA, which is getting pretty close to Ray Dalio's positioning here, right? So I just find it super interesting. Yeah, Railboy, like this is the thing, right? Like I hate it so much because nobody talks about shit like this as much anymore, right? Like the days of people really just interested in boring stocks is gone. Like it doesn't make any money, man. I love the railroads. I don't really own them. I don't like, I get them and I care for them. I just, outside of my VDY, the few ETFs that I hold, the railroads are just not that concentrated. They're great stocks on an individual basis, but like, I feel like that's what people should be like talking about when I watch YouTubers, is like buying railroads and, looking at banks like JP Morgan and Bank of America and, MasterCard and Visa, but you always find yourself so fixated on, oh, there's Netflix earnings. What's NVIDIA talking about? Oh my God, GME, like the degenerates are back. Like what's going on with crypto today? And it's so easy to get lost down these rabbit holes. VFE to VFO or VOO is not VFE the better choice with the BRICS in US $35 trillion debt. It's the same ETF. If the US goes under, VFE goes with it, baby. They're the same thing, exactly the same thing. Campbell's Soup, lol. Like I've been watching these, like, so to put it in perspective too, right? Like not to get too like into the weeds, because I try and keep my parents' stuff pretty private, but like I've been fortunate that my parents have trusted me to help manage their portfolio, and my God, they have done so well buying such boring stocks. And like we always talk about BTI because like I just look at this, and this is like the grandpa of the grandpa stocks, and my parents, they smoke, not like they used to, but they used to smoke. And I said, well, it'd be good to make some of that money back on, all those cigarettes he smoked over the years. And like they locked in like over a 10% yield, and they bought like literally here. I think it was like somewhere around here they bought, like right around this period here. And then it went down, and my mom was like, it hasn't really done anything for us. And now they're up like 30%. And it's like the return on this has been like stupid just because of when they bought it. And it's just laughable to me. And same with like Kimberly Clark. And I'm looking at like all these grandpa stocks. Like I think Kimberly's really had to come back. This one I find really interesting because it hasn't done much for the last 5 years. But if you bought any of these dips, like these major dips, like you've seen a pretty substantial return with a very healthy dividend yield. I mean, what's Kimberly look like from a dividend perspective? I mean, they've been pretty good at increasing them too, haven't they? Yeah, I mean, this stuff doesn't get clicks, right? When you got 81 cents versus $1.22, it's not a bad dividend increase. We're not talking about a doubling. The Canadian banks do a better job at doubling your dividends than this stock has. Sean, really, Brookfield buying the world. Yeah, Brookfield's definitely been gobbling up a lot. That's because, I don't know, I feel like they're like retirement portfolios. Like they just get all this retirement money. And Brookfield's got kind of like retirement lingo, like boomers hanging over it. So much money has gone into those investments. What else is going on? They're invested all over. Yeah, I mean, it's like buying a diversified ETF, right? So Kyle, what's a hold forever stock? I mean, there's so many, right? Yeah, basically the stocks that I've traded in and out are all hold forever for now. I have speculation on tech. So I'm like, when I look at like a company like Meta and like Google and all these companies, like I recognize that there's probably a good 5 to 10 year period where these things are going to do exceptionally well and continue to. But when you look far enough out, it's really hard to tell that they are hold forever kind of companies, right? Like this is why I love watching Warren Buffett so much, because like he is a guy that wants to buy and hold stocks. I mean, from his quotes forever, right? So when you look at what he's buying, you need to look for companies that are highly moated, highly undisruptible, have been highly regulated by the government, because at least you have certainty into the future. Like Apple is not that regulated. Microsoft is not regulated yet. These companies are highly monopolistic in their behavior. Google has been like a gavel and hammer, when it comes to what we're about to find out happens when, these companies get deemed monopolies and whether they get severed up. We don't know yet what the fines look like. We don't know anything yet. So there's so much risk into those companies. You can't really state their hold forever if we're talking about the path of least resistance to a return, or at least a long-term return, right? So that's why, a lot of people in here are talking about the railways. We're talking about things like Kimberly-Clark. We're talking about stocks that, yes, you're not going to see immediate outsized returns. You're not going to outpace the S&P 500 likely with these in a short period of time. They're very boring stocks, but the reason is that they have moats. Like the railways, even if EVs become a highly predominant thing, and I mean, there was I don't know if it was Elon Musk or who released it, but they were showing that like if you could get EV tractor trailers and they become as efficient as people think they are, they'll be the cheapest form of travel ever made. Like right now, the railways are the cheapest form of travel for moving large amounts of goods. But the problem that lies in that is even if you find a cheaper form of travel, you can't put chemicals on a highway. Like people keep forgetting, like trains are moving highly toxic chemicals. There's so many things that the trains are set up for that like you can't, like the grains and food and all this stuff. And it's just, they're traveling, avoiding like major cities, and it's removing traffic from major highways. And like, it's so efficient. Like they're just not going to go anywhere, right? Like what's CN doing right now? I mean, if we take a look at like, I think the two comparables that we usually look at is what CNQ versus, or not CNQ, sorry. CN Rail versus what's the other one? Kansas City. The other one that got like bought out. And Kansas City has way more growth because obviously they're expanding, I think, all the way down to Mexico or something like that. But you look at Canadian National Railway, right? Like 5-year performance is really boring compared to the S&P 500. But if you zoom out on the long chart, right, like it removes all that volatility. This is why I love the utility sector, right? This is why I've been buying XLU. Like same with VNQ and like some of these sectors, I think, this is probably more predominantly stable sector. And I love these kind of stocks because, I think Duke Energy, Southern Company, the top weighted stocks in this ETF you could buy. I own them once upon a time before I sold them and bought indexes or tech stocks or whatever stupid thing I did. But I mean, if you find look at ETFs that have incredible stability, like low volatility ETFs. There's BMO has a low volatility ETF. You look at utility ETFs like this one, and this is where you get those grandpa stocks that have been around forever, and they have very little volatility and offer very stable returns and income. And one of my favorites to follow, again, I'll show you real quickly, is the BMO low volatility ETF. And I spelled that horribly, but you'll get the gist. So the ticker is ZLB. Let's take a look at this real quick, because I love sharing this because the holdings that are in here, people just don't talk about it enough. And I think it's just because, again, the yield here, when you're talking the management fee, is a little bit higher than I'd like to see it, but it's reasonable for what you're getting, in my opinion, if you don't want to manage your own portfolio. But if you scroll down and we take a look at the holdings, look at this. You got Metro, Loblaws, Hydro One, Empire Company, Waste Connections, the TMX Group, Fortis Canada. Like when I look at this portfolio, like this is a dream to me. This is a dream. I mean, like these stocks, nobody really talks about. Who the fuck talks about Loblaws and Metro? I'm probably the only person on YouTube that mentions Hydro One ever. And Hydro One's a great company that I still flip-flop on if I'm going to pick it up or not, and I always miss the dips. But when you take a look at the performance of this, yeah, the 5-year return is nothing stellar, and the income isn't super high, but the dividend growth is highly stable. The stock, it's very low volatility, so you're not seeing the same swings. So the point of looking at these kind of stocks is you want to pair them with your growth, in my opinion, because like if you pair this with the S&P 500, it removes a lot of the extreme volatility. It increases your average dividends, and it kind of just balances everything out with stocks that I think are great to own, that you usually don't get high exposure to in general index funds, right? So you could make something like, so you could put like 50% of your money in the S&P like I am. And then if you want to increase your yield, you buy some stocks like this. And again, I'm not talking about increasing your yield by like 5-10% buying BTI. I'm not in retirement yet. I'm looking for highly stable long-term growth. So I can get it from ETFs like this, right? So, I mean, you know, and then comparably, I'm always looking at the individual components because I could still see myself buying Hydro One. I got pissed off because I was going to buy Hydro One down here. I saw Hydro One here and I'm like, I should buy it. Right here's a great place to be buying Hydro One. And here we are. It's up like fucking 20% in a goddamn month. The 3% yield's gone. You know, I like these kind of stocks. Same with Fortis. I know a lot of people have a love-hate relationship for Fortis because it didn't do so well over the last 5 years in comparable. If we just take a look, I mean, like the last 5 years have been pretty boring. But again, we're talking about a company that's paying, you know, a 4% yield, and there's no volatility to it, right? Are we going to see a crash or no? Getting tired of all this crash talk, bro. That's never going to go away. Do I got to take you back to the stream and show you this? This is YouTube on the average. Hell, you think Meet Kevin's bearish? I mean, I grew up with Peter Schiff. Peter Schiff is the king of the bears, baby. What's he been talking about? I haven't even looked at his YouTube channel in forever, but something tells me it's going to be high. He's live right now. Let's take a look. We should take a look at his live if he's live. Economy in trouble as recession looms. You scroll back to his early day videos, it's all the same shit. The banking crisis has gone global. That was a year ago. We go even farther back. I swear to God, bro. Once a bear, always a bear. You know, good politics is bad economics. The risk of the market crash keeps rising. That was 2 years ago. Go back as far as you can go back on this guy's video, this channel. Like, help, Biden's cheat to avoid the economic F. Like, I mean, it never ends. Is he live right now? Let's scroll all the way up. Let's take a look. I haven't seen Peter Schiff in a coon's age.
The prior month. Look at the Chicago MI, 46.1. Again, anything south of 50 is in a contraction. And we're at 46.1. That was below the estimate of 46.4. Yes, it was above the 45.3 from July, but that was a disaster. That was one of the lowest numbers we've ever had.
Peter Schiff, I can't stand this guy. Like, you want to go like build a bomb shelter and listen to just pure fucking scum? This is this guy. Shall I remind you one more time before we finish this stream up? I'm always going to reiterate. I could have sit here and just bitched about every single one of these events and why the economy is going to tank and it's going to be a full-blown meltdown crash. And yet, you know, do you remember what happened in 1990? I sure as fuck don't. Do you remember what happened in the dot-com bubble? I don't. I was too young to even know it was happening. Hell, I was 16 during the 2008 financial crisis, and I don't even remember that happening. Do you even remember people complaining about 08? My parents, I never remember my parents complaining about it, my grandparents. Hell, I was so oblivious to what was going on in the economy as a teenager. And that's how you have to act, oblivious, or you're going to be, yeah, bro, I miss the drama between him and his son because his son and the whole Bitcoin feud was hilarious. Yeah, things are crazy, man. Things are crazy. It's a grift, right? We're all grifting here. We're all grifting. I'm just trying to be an honest grifter the best that I can. Timing the market beats timing the market. There was a video I was just watching, bro. There's a video I was just watching of, I think it was one of the guys that was on that, you know, he hosts Dave Ramsey's show once in a while. And he was showing you over the last 50 years, or no, maybe it was the guy, it doesn't matter who it was, but he goes back, watch the videos where they show you like over the last 50 years, if you missed like the 20 best trading days, how different your portfolio performance would have looked. If you just missed like 20 of the best days in the market over the last like 50 years, like it's crazy how much money you've missed out on, right? So that's why when you listen to people like Meet Kevin, like you just got to respect it as entertainment value. Like, because you can't get caught up in holy shit, the market's going to crash again. I'm going to go short the market. I'm selling my stocks. And then boom, the market shoots up 8% in a week. Like, you know, you'd be screwed. You'd be royally screwed. Like you'd be giving, it goes back to the expense ratio thing. It's like, you might as well be paying somebody. Like, that's the thing. If you're dumb enough to fuck around like that, then you're dumb enough that you should be paying somebody like a 1% expense ratio. And there's nothing wrong with that. You just have to admit that I don't know what I'm doing. I can't control my own psychological behavior. I get caught up in hype and stupid bullshit, which if you're one of those people that's just YOLOing into things like GME and Palantir and Tesla, like you're one of those people that should just be buying a mutual fund because you're going to screw yourself. I promise you, for the 99% certainty, you're probably going to lose money if those are the stocks you're most focused on. But again, on YouTube and in the sphere of social media, it's all we get caught into. You got to be a bit careful, man. You got to be careful. Yes, 2008 from the T dot to Saskatchewan. Best choice of my life. Yeah, I agree. Moving around. Peter Shiv, True Man. What else is going on here, guys? I'm gonna get out of here in a second. Go enjoy condo life and maybe go sit in the sauna for a bit. What else we got going on? Long term, what do you say? 5, 10, 15 years? To me, it depends on what I'm doing. The ETFs that I'm buying are long term. I'll hold them forever. I have no reason to sell them except for gains in the future when I need them. Like I'll keep the S&P, but eventually I'll take profit on it. Even in my corporation, right? Eventually I'm going to take profit on my corporate S&P 500 gains to pay myself out, and God knows what I'll do with it then. But yeah, 5, 10, I think 5, 10 years is more of a swing trade. 3 to 5 is what I usually look at for swing trades. And then, 10, 15 plus is usually just my index in ETFs. But honestly, I'm looking at retiring in probably about 5 years, maybe 5 years. I want to be there. And then I'll probably start, maybe, I don't know. We'll see where I'm at financially with my job, but I don't even look 30 years out anymore. I don't want to think that long because I might be dead. Obviously, I plan on making it to my 60s, but I tried to fast track retirement, and I think I can get there in the next 3 to 5 years. So press that like button if you guys are on a similar path who want to retire in their 30s, because it's not that far-fetched, man. I've started to realize like this far-fetched idea that you need millions of dollars, which is kind of extreme because like we're pretty much at the $1 million mark already, me and my fiance. So, but I don't, even looking at my parents' retirement, and I'm looking at like, it's just how you control your expenses. I mean, you really don't need that much to retire if you have a paid for house. If you're going to rent, are you going to go live somewhere that's more affordable? Like, you plan on staying in an area? Like, figuring out that retirement number really debates everything. But I hate listening to people like, oh, I need $2 million. It's like, I don't think you need $2 million to retire. Because I mean, if you can make even like 5% on $500,000, you're going to be generating, what is that, like 25 grand a year? And if you own your house, like when I look at the expenses of like I live in Toronto and our expenses are not that bad. I'm like, if we just paid this condo off, like 25 grand realistically, if it's after tax, could basically pay for all of our bills. I don't own a fucking Mercedes. So, my retirement doesn't look like it needs that much money. So, I mean, if I can get beyond, $30K a year in passive income, or just, stock growth in general, like I'm in a good spot, man. Kyle, you rock market. So the market. So thanks, man. Now what do you make? It's what you save. Exactly, man. Like, there's people making 100, like we were just talking about this today. Like I look at what my car cost me, and there's people driving Mercedes, and I looked at what it cost to finance a Mercedes today. And I'm like, it's like $1,200 a month just to like pay the debt. It's like $1,200 a month is stupid. Then you got to pay insurance, and you got to pay gas, and blah, 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 blah. My first house I bought in 1972, and it has had an 11% mortgage. And now people are hurting big time with a 7% mortgage. Yeah. But, we bought what we could afford, and I was earning $3 an hour. Yeah. But, back then 2 homes at an 11% mortgage, your house probably cost like 50 or 100 grand. Like, an 11% mortgage today, like I couldn't even afford it on this condo. If we had to pay an 11% mortgage on like, several $100,000, that'd be nuts. That'd be nuts. Well, our mortgage isn't 700,000, but the price of these properties with people putting 10, 15% down, that's not enough. Even at a 5% mortgage where we're at today, like with the current mortgage rates, like you can't put a minimum down payment. I don't know who's affording, a property today with a minimum down payment in major cities. It's impossible. 19,900 for a semi-detached. Holy shit, bro. That's awesome. I wish. I'm just thankful. Like I have a wife or a fiance and a house. We were cracking jokes at each other at my buddy's place today. And it was kind of funny. I was like, bro, I wouldn't even be able to afford a house if it wasn't for my fiance. Like, she's the one with the real job and the real stable income, and she had no problem getting a mortgage approval where I had to fight tooth and nail to get it. Bro, things are so different today. It's a calamity for younger people. I think the younger generation is so screwed for so many reasons. Like, we won't get into that in this video. I could ramble about that for days. The cost of education's higher. They get out of school, they're immediately in the hole. Fuck, housing already costs too much for them. They're screwed before. That's why people don't have kids. You can't even afford to have kids because by the time you're in your 30s, you barely got your shit together still, let alone friggin' everything else that's coming down on you, right? it's a different time, man. It's a different time. You're the man, Kyle. Keep up the great work. I do appreciate you stopping by and, you know, appreciating this clown of one of many on the internet here. I've been around since 2019. I don't have 100,000 followers. It's very sad. It's a shame, but I appreciate the few that stick around. One and done with the kids, baby. Yeah, we're kind of getting there. We're kind of getting there. We're thinking about kids. We probably have one kid, but I don't know. The wife is kind of toying with the idea of it. I don't really care to have or not have kids, but if the wife wants it, I'd be down. It's more or less what she wants. She wants kids, I'll have a kid. If she doesn't want a kid, I don't care. I don't need a kid. We'll see how it goes. I'll let you know, because that's going to be another defining factor in this game of, you know, again, I don't care. Ideally, if you're just financially stable, I think that is the defining factor to having kids today. It's like, you know, one is enough for us. I agree. But it's like, you know, if we can just, in the next 2 or 3 years, if we get our finances worked out where things are, you know, mortgages mostly paid down, savings are good. Having a kid's not a big deal, but having a kid without savings is terrible. It's fucking horrifying. Anyways, folks, I don't want to keep rambling. It's been a good night. Enjoy your long weekend, folks. Pay $20K for my house with half an acre back. Jesus Christ. Stay cool. Stay awesome. Don't make me, you're all making me feel bad about your cheap homes that, you know, if only I was just born 10 years earlier, life would have been so much better. Peace out. It can still be good, damn it. Don't be negative.